Greetings everyone, Scott Janad, Infinite Banking Director for FFL SRS. We're here today to talk more about examples of opportunities for either personal or business. Whether you know people that are in business, have a business, or anyone that's just doing things like buying real estate or having their own turos or whatever it is, their own trucking companies, doing day trading. Today we're going to show you how to utilize Infinite Banking Concept with Lafayette Life software on how to design these. Now we're going to use a 40-year-old today. And when you log into the software and you go there, we're going to put in, let's say California today, nice and sunny. We're going to go to either the Contender or the Patriot. Now why would you want either or? Okay. Now what I do is I use the Contender product for most smokers. Okay. Without getting into detail about why, right now if you're a smoker or if you're in your late 50s, the Contender product works a little bit better. But we're going to use the Patriot today, and we're going to say they're a non-smoker, 40 years old, and we'll start with that. So here we go. We got the Patriot product, 40-year-old, and we're going to do something very simple. We're going to come here to the Solve tab, and we're going to drop down to Base PUA Blend, and what we want to do is we want to make believe that someone has $100,000. Now, how many business owners do you know? How many people or friends that you maybe have associations with that might have cash sitting in the bank doing absolutely nothing, or they use their money, but then they have to wait to earn income or profit to pay it back and replenish? Because that's all we do in society. We either borrow money from other people, other institutions, and pay them back with interest and get nothing in return, or we're going to use our own cash and spend it, but now we got to replenish and we lose the opportunity cost we could have earned somewhere else. So now I'm going to show you where you can use this as a base guideline. Well, we're going to start with a minimum premium of $15,000. So what I'm trying to tell you here is anybody that has $100,000 or any agent out there that's going to use this as an example, this is a base guideline. In order for someone to put $100,000 into a policy like this for infinite banking and have access to it like leverage, the minimum premium so that this policy does not become a MEC, a modified endowment contract, is $15,000. Let's start there. Okay, keep it very simple. We're going to do 50% to the base, 50% to the paid up additions. Now this FPUA, don't worry about it. It's a product they used to have at Lafayette. They don't have it anymore. They just haven't wiped it out of the system. So don't worry about it. You don't have to use it. Now what we need to do is we want to avoid the MEC. And the reason why we love Lafayette is because they give us so many different options. Other carriers might give you a 10-year or a 20-year term, only two options. Well, here at Lafayette, you got a 7, 10, 15, 20, and a 30-year term. What is that? Why is that important? We need more death benefit in these policies in order to create a non-MEC, okay? So when we're doing that, a 40-year-old, what I do is I take it out to retirement ages. So if somebody is, 45 or 60-something, we like to take it to somewhere like 62 to 70, 71. That's the retirement ages when people retire, around the 60s, maybe 70, 71, since they're pushing that along to age 72 for RMDs. But let's just use 20 years for now. So now we're going to go here, we're going to hit next. Now, if somebody has cash sitting in the bank, what we're going to do is we're going to leave it annual, okay? Because what I like to teach and what I think is very beneficial for the client is if you have the cash sitting somewhere doing nothing, we can just go ahead and put the whole $100,000 in, and we can peel out the $15,000 and put it right into the annual premium. Now the client doesn't have to pay anything for 12 months. Hey, you get paid at the same time as an agent, and now the client is done and waits till the next year. So this is how we design it. We're going to view the illustration. Now you can see here, I just viewed it on $15,000. We haven't added the additional $85,000 to total the 100. I'm going to show you how I go back into the system and put it in. So all we're doing here is we're viewing the illustration the first time just to have the premiums of $15,000 locked and sealed in the software. Now what I'm going to do is I'm going to go to right here to the Writers tab, and I'm going to add the extra $85,000. It's very easy. 3 simple moves. I don't touch anything up here. I come right down in this box that says duplicate entries, how many years. I'm going to put the 1 year only at this moment, and I have a reason why. You move over to the lump sum column. I put in $85,000, hit enter, and I only want that for the first year at the moment. You always want to avoid MEC at any point you can. 20 years to match the term. And now you're ready to view the illustration. For some reason the software doesn't recognize every time you go in and out. So when you have to go back and forth in the software, please don't forget to avoid the MEC whenever you can, please. So now we're going to view this illustration and we'll talk about it and how to explain it to your client. All right, so here you see, again, Lafayette Life been around for almost 120 years in business. Never once have they ever missed a dividend interest credit, okay? Doesn't matter what the dividend is or what it is at the moment. It's really about leverage. So understand, when you're talking to your clients, this has nothing to do with investing. We're not investing money. We are adding an asset to our portfolio that we are able to leverage, like a home equity line of credit. So when you borrow money from a home equity line of credit, so let's say you have $50,000 of equity in your home, and you're going to borrow $20,000 to fix your bathroom up. Who are you paying that loan back to? The bank? And if you get late on a payment, you pay them a late fee. Well, how would you like an asset like this that has $50,000 in cash you could borrow? Now you take out $20,000, you go fix up your bathroom, and how would you like to earn dividends on the $50,000 and pay back the $20,000 whenever you can, just like you'd be paying the bank back? That's called leverage. And now we found the asset that will allow you to earn and borrow at the same time. So now when you're looking at this illustration, understand we're going to focus on the non-guaranteed column for dividends, because even though by law no carrier can tell you you're guaranteed to get a dividend, we know for 120 years Lafayette Life has never once missed it. So let's just stay there. So you can see in year one, this person puts in $100,000. Now if they want immediate access right back out when they get approved, and by the way guys, these are fully underwritten. It takes about 45 days to 60 days before you get approved. A nurse is going to come out, and please tell your client and anticipate they're going to get a blood and urine exam. Just assume it's going to happen, okay? They're going to come out, check blood, urine for, nicotine, chew, tobacco, marijuana, cannabis, and it's okay if you smoke. You're just going to be a tobacco rating, okay? Now they're also going to order your doctor records the last 3 years and all the stuff that they're going to need. So just give your client all the information. But now when they get approved, when they put $100,000 into the policy, Lafayette Life will give you anywhere between 75 to 80%. That's what I like to tell the client. I like to underpromise and overdeliver, okay? So now, let's just make believe that you're going to go buy a real estate property for $400,000. And typically, banks want about 20% down. So that's about $80,000. Okay, why would I give the bank $80,000 from my bank account? Because now when I give it to the bank, I have no more cash. Now I have to work, I got to replenish it, or I have to get a renter in. How long is it going to take you to recover $80,000? I don't know, many years. Now here's an alternative. What if you put $100,000 into this policy, and all you're doing is transferring it from Bank of America right into here? But now you get access to $80,000 out of that 100 that you just gave Lafayette when you get approved. And now I take the $80,000, I give it to Bank of America, they give me a mortgage, and then I get my friend Eli to rent it. And as Eli's giving me the rent, guess what? His rent is going to pay the mortgage back to Bank of America and the loan back to Lafayette. And while Eli's paying both my loans back, I'm still earning a dividend on that $80,000 I just gave the bank. How would you like to make money 3 ways using other people's money? This is how you can do it. Now, if the guy doesn't do that, and he just saves his cash and he just replenishes it, or he just transfers it over here and just moves it, redirects the funds from Bank of America to this policy. At the end of the year, this client will have access to $90,000. So yes, you put in 100, you get 90% access to your cash. Who wants that? Because now, if he has anything he wants to invest in, day trading, stock trading, if he wants to run a trucking company, heck, I got guys doing Turos, putting in $500,000 in this stuff. So I'm giving you a baseline where you're looking at $15,000 is the minimum required that they got to keep paying. But if I told you this client, whether it's a personal or a business, can put in $100,000. See, my S-Corp or anyone's S-Corp or LLC, we can show business owners how to take money from their business account and fund a life insurance policy on themselves and use that bank account to pay the premiums. There's no tax write-off to do that for the business. But when you get the money to go buy equipment, that equipment, you can write that off for the business, okay? So now, $15,000 is the minimum requirement. but they can put up to $100,000 every single year in this policy. So here's the power of what this is. If you look here, again, this person decides to put in $100,000. Now, what if they don't want to do that every year? Maybe they only want to do the $15,000. Well, now look in the third year. This person puts in $15,000. They receive a dividend of $5,100. And when they add those together, subtract out the cost of insurance, the increase they receive in their new line of credit is $15,227. So I ask you, is the $227 more than the $15,000 you laid out of your own pocket? It's not a lot, but it's not an expense to you anymore, is it? See, life insurance is not an expense when we use the infinite banking concept this way. You're now making a profit on your premium. You mean to tell me you wouldn't put $15,000 into your business account if you knew your business account was going to generate more than you contribute? Because 10% of $15,000 is $1,500 for $16,500. You mean to tell me that you almost made a 10% return in year 5? And you have $120,000 of cash you can use as a line of credit for your business? That's crazy. I'm going to show you how to add the extra $100,000 into the whole thing. So we're going to get out of this for a moment. I'll pause that, and we're going to come right back here to the rider section. And all I'm going to do is add the $85,000 every single year because this business loves to fund it. And remember I said, don't forget to avoid the MEC, to match the term rider. View the illustration. And now you'll see every single year $100,000. It's not required that they put in the extra $85,000. Okay? They can put anywhere up to $15,000 and $100,000 whenever they want to. And Lafayette Life has a catch-up provision, which is fantastic, because any years you miss within those first 7 years, you can catch it up, kind of like rollover dollars. It's pretty fun. So now you got a guy putting in $100,000 from the business every single year. See, the minimum, still $15,000. But now look how powerful this is. $100,000 goes in year 3, same way. He just made a 2.3% return on his own money. Next year, 7% return, 12% return. In the 10th year, he keeps putting in $100,000. He just made a 39% return on his own money. You mean to tell me his business wouldn't like to make 39% in an asset like this? Because I tell you what, it's not earning 30% in their savings account sitting in the bank, is it? So now you can show business owners, personal. It doesn't have to be business, it could be personal. You can show Turo companies how to do this, landscapers, general contractors. Heck, if somebody wants to put in $500,000, Lafayette allows you to put it in. Up to $500,000 PUA. That's what you can put in. Some carriers only $250,000. So what does the illustration look like, Scott? That's what they say. It's very easy. Multiply all these numbers by whatever the person wants to put in. $200,000, is that what they want to put in every year? Fine. The premium's going to be $30,000. It's going to be what? $170,000? Then we'll put $500,000 in. Multiply everything by 5. Scott, they can't put $100,000 in, they can only do $50,000. Great. Now you divide the numbers by 2. It's that easy. It's just simple math. You don't have to show multiple illustrations. Confused people do nothing. Please, don't confuse your client. You just want to articulate the concept of what we're trying to accomplish here. It's an asset that you can leverage at the same time you're earning dividends at the same time. It's a line of credit. That's all it is, and that's the best part about this. You now found an asset. You can borrow money, do whatever you want to do with it, and pay it back the same way you'd be paying all the other institutions you've been, paying and replenishing, but now you're earning dividends at the same time. That's power. So now when you're looking at this, you can see here after 10 years, they got $1.1 million of cash. Okay, it's not what did I put in and how much do I have. That's not this. Because when you have clients asking you, when does my money meet my money, that's because they've never had access to their money in the last 15 to 20 years. The question is, what are you doing with all this cash that you've had for those 10 years to leverage your money? That's more important than when does my money meet money. Hope this makes sense to you. Stay tuned for a moment because I'm going to talk to you how you get paid commission. So agents, this is how you get paid commission on something like this. If you have someone that's going to put $100,000 into a policy, you get paid the majority of the money from the base. So understand, $15,000 is what they're getting paid. All right, that's what they're paying per year. Now, you're going to get paid on the base, the term, and anything PUA. But how? Well, right now, out of the $15,000, this is what you would get paid commission right now. Okay? $7,500. So now $7,500 is what you're going to get paid on this $15,000 premium. So what about the other stuff? Depending upon your level of FFL, well, let's just make believe you're getting 100% of this. Now the term rider that you get, maybe it's 50%. So let's just make believe it's $2,000 or round it up. So maybe you're going to get a commission check of $1,000 on that. So now you get $7,500 on the base, $1,000 on the term, that's $8,500, and anything related to paid up additions, let's just make believe it's about 1.5%, depending upon your level. But if it's 1%, that's $850. So now you're making over what, $8,500, $800, what, $9,300? Let me ask you this. You put $100,000 in 2 different assets, what's your commission on something like that? Maybe 4, 5, 6%, I don't know. You just made almost 8%, 9% on $100,000. The client gets more access to cash than they've ever had before. They get life insurance, estate planning, living benefits, and now you're going to get paid almost $9,000 on something like this. It's pretty nice, pretty easy. How many business owners do you know? How many people you know sitting with cash that has either 25, 50, 100,000, 200,000? Sky's the limit. Show people how to leverage this asset now for their business, their personal. We can show that. Make more money. I'll show you how to do that. Appreciate your time. Thank you.